Welcome to the Opening Bell Report.
Okay, I have to start today with a question that I think, well, every trader was probably shouting at their screens yesterday.
I'm sure they were.
Did you see the ticker tape for Novo Nordisk? Because if you blinked, you might have thought it was a typo.
It definitely woke a lot of people up, that's for sure.
We're talking about ticker symbol NVO. The stock closed at 47.64. That's a jump of nearly 10% in a single day.
Right.
And then, just to add insult to injury for anyone betting against it, it kept climbing after hours, pushing right up near that $50 mark.
A 10% move for, a small cap tech stock is, it's a Tuesday. But a 10% move for a pharmaceutical giant this size.
Yeah.
That's a tectonic shift. It takes billions of dollars of buying pressure to move a ship that big that fast.
Exactly. And that brings us to the elephant in the room, or maybe the dead cat in the room, because usually when a massive stock that has been just beaten down for months suddenly pops like this, the cynic in me just says trap.
That's the right skepticism to have.
Is this a dead cat bounce? A momentary gasp of air before it dives back down? Or did something fundamentally change?
Well, we have an analysis report in front of us today that claims this is absolutely not a trap. In fact, the report makes a very, very bold assertion.
Okay.
It says yesterday wasn't just a good day, but the start of a run that ends with the stock at $75.
$75. That is ambitious. That's roughly a 50% upside from where we are right now.
It is. But here's the fascinating part. Usually when we talk about a pharma stock running up 50%, we're talking about, what, a clinical trial result?
Right, some eureka moment in a lab, they cured something.
Exactly. But there was no eureka moment yesterday. There was no secret patent unveiled. The report argues this whole rally is driven by something much more boring, but much more powerful.
And that is?
The valuation anomaly.
A valuation anomaly. So in plain English, the math is just broken?
Essentially, yes. The market has priced one of the most successful companies in the world as if it is a dying business. And the report's argument is that the rubber band has just stretched so far in the wrong direction.
That it has to snap back?
It has no choice but to snap back.
Okay, so our mission today is to figure out if that rubber band theory actually holds water. We're going to unpack the math behind this so-called inevitable rebound and see if Wall Street has truly lost its mind on this one. But before we get to the price targets and the PE ratios, we have to look at the crime scene.
Right. How did we even get here? Because NVO wasn't always trading in the 40s.
Oh, no, not at all. If you pull up a long-term chart, this stock was trading at highs north of $90 not that long ago.
It's been cut in half.
Effectively, yes, cut in half.
Which is just wild for a company that basically owns the obesity market.
Yeah.
So what happened? Why did everyone suddenly hate this stock?
It's a classic case of the narrative overtaking the fundamentals. The market just fell in love with the fear narrative.
The fear narrative. And there were two main boogeymen here. First, you had the supply chain issues. Demand for Wegovy and Ozempic was so high that Novo literally couldn't make the pens fast enough.
Which honestly sounds like a good problem to have. Oh no, too many people want to give us money.
You would think so.
Yeah.
But Wall Street interpreted it as missed opportunity. They saw billions of dollars being left on the table because of these manufacturing bottlenecks.
Okay.
And then the second boogeyman showed up. The fear of commoditization.
Right, this is where the compounding pharmacies come in.
Exactly. Because there was a shortage, the FDA allowed these compounding pharmacies to basically make, let's call them knockoff versions of the drug to meet demand.
And the market panicked.
Completely panicked. The narrative became, well, that's it. The moat is gone. Why pay a premium for Novo's brand when you can get some generic mix at a clinic?
So investors assumed that the pricing power, that ability to charge premium rates, was just destroyed. Forever.
That was the fear. They priced NVO as if it was becoming a generic utility company. The whole sentiment shifted from high-growth innovator to dying legacy business almost overnight.
But looking at the technicals in the report, it seems like the sellers have finally just run out of steam. It mentions a V-shaped recovery.
Right.
For the listeners who aren't glued to candlestick charts, what are we actually seeing here?
Well, think of it like a coiled spring. When everyone who is scared has already sold, there's nobody left to push the price down. The report points out a gap fill pattern.
A gap fill.
Yeah, when the stock crashed, it left this vacuum in the price chart. Markets hate vacuums. And this recent price action, that sharp V shape, suggests the market is rushing back in to fill that empty space. It's a sign of capitulation.
The bears are done.
The bears are done and the bulls are stepping back in.
Okay, so the panic selling is over. Now let's look at what the buyers are seeing. This is part of the report that really stopped me in my tracks. The shocking stat. We need to talk about the price to earnings ratio, or PE.
This is the meat of the thesis. This is where the whole anomaly sits.
So right now, Novo Nordisk is trading at a PE of what is it, roughly 13.11?
Yep, 13.1.
Now, 13 sounds low, but numbers in a vacuum are dangerous, so put that in context for us.
Okay, so you want to compare it to three things: the sector, its own history, and its competition. Let's start with the sector. The average pharmaceutical company trades at a PE of about 25.
So Novo, the leader in obesity, is trading at roughly half the valuation of just an average drug maker.
Correct. Now look at its history. Typically, NVO trades at a premium around 40 times earnings because it grows so fast.
40!
So it's at a massive discount to its own historical average.
But here's the comparison that I really want to challenge you on, because this is where the report gets aggressive.
Yeah.
It compares Novo Nordisk to Eli Lilly.
The main rival?
Exactly, they have Zepbound. So what's Lilly's PE?
Eli Lilly is trading at a PE of 45 plus.
45. Okay. So Novo is at 13. Lilly is at 45. That is a massive disconnect. But, and I'm playing devil's advocate here, is it possible the market's right? Maybe Lilly is just a better company. Maybe their drug is better. Their pipeline is fuller. Is it really an anomaly, or is Novo just the uglier sibling right now?
That is the multi-billion-dollar question, right? Yeah. And sure, Lilly has had a great run, but ask yourself this: is Eli Lilly's future earnings potential worth 3 times more than Novo's dollar for dollar?
3 times seems excessive.
It implies that Lilly is priced for absolute perfection, meaning nothing can ever go wrong, while Novo is priced for total disaster. Like walking into a car dealership. You see a brand new Ferrari, this Eli Lilly, selling for full sticker price. Yeah. Then right next to it, you see another Ferrari, maybe a different color, but it's Novo Nordisk, and it's selling for the price of a Honda Civic.
You assume the engine is missing.
Exactly. You kick the tires, you look under the hood, you assume it's broken. And that's what the market's been doing to Novo. They assumed this compounding pharmacy issue was a blown engine. But the report argues the engine is perfectly fine.
And the math on this is startling. The report says Novo doesn't even need to catch up to Lilly if it just re-rates to half of Lilly's multiple, let's say 22x instead of 13x.
The stock price doubles. That's the beauty of deep value. You don't need magic to happen. You just need the market to stop being irrational.
Just to get back to average.
If the multiple goes from 13 to 22, you are looking at a 100% return on the stock, even if their earnings just stay completely flat.
But are the earnings staying flat? Because if the business is actually broken, a low PE is justified. That's a value trap.
Right. It's cheap for a reason. So let's look at that financial health check. Is the company actually broken?
The report lists some elite margins here. Net profit margin is sitting at roughly 32%.
Which is just incredible. For every dollar of sales, they keep 32 cents. That's software company level profitability, not manufacturing.
And then the return on equity, or ROE, is 58%.
I want to pause on that one. ROE is basically how good management is at using your money to make more money. 15% is world-class. It shows extreme efficiency.
But the one that really counters that fear narrative for me is the gross profit margin. It's at 84%.
That is the moat number. Remember the fear about cheaper generics?
Mm-hmm.
If Novo was losing pricing power, if they were being forced to lower prices to compete, that gross margin would be crashing.
Mm-hmm.
It'd be 60%, maybe 50%.
But it's not.
It's at 84%. That tells you they still have immense pricing power.
So why is it so high? I mean, aren't they just making liquid in a pen at the end of the day?
Well, it's not just mixing chemicals in a bathtub. These are biologics. They require massive sterile facilities, complex cold chain logistics to keep the drugs at exact temperatures from the factory all the way to the pharmacy. The barrier to entry isn't just the patent. It's the billions of dollars in infrastructure needed to make this stuff safely. That's the real moat.
Okay, so the business is healthy. Revenue is up 25% to $45 billion. Operating income up 25%. But I have to bring up the bear case again.
Go for it.
The report notes that free cash flow, the actual cash hitting the bank account, looks mixed or lower than expected. If they're so profitable, where's the cash?
That is a very common criticism, and frankly, it's a bit of a lazy one if you don't dig in. You have to distinguish between maintenance spend and growth spend.
Okay, break that down for us.
All right, imagine you own a rental house. If you're spending all your rent money just to fix the roof and patch leaks, that's bad. That's maintenance. You aren't really making money.
Right.
But if you're taking that rental income and using it to build a second house on a lot next door, your cash flow might look low today, but you are doubling your future income potential.
And Novo is building the second house.
They're building the second, third, and fourth house. They are aggressively reinvesting into capital expenditures. They're building massive new factories to solve that supply bottleneck we talked about earlier.
So there's a bit of an irony here. The market punished them because they couldn't make enough drugs.
Yep.
And now the market is punishing them because they're spending money to make more drugs.
Precisely. You can't have it both ways. The report argues this low free cash flow is actually a hugely bullish signal. It means management is so confident in the demand for the next decade, that $100 billion obesity market, that they're willing to spend billions today to capture it.
They aren't burning cash, they're building the runway.
Exactly. It's an investment in dominance.
That makes a lot of sense. Okay, let's pivot to risk management. Because even if the story sounds good, I'm a cautious investor. If I buy at $47, what protects me if the market decides to panic again?
The dividend.
The report highlights the dividend yield, yeah.
This is your safety net. Because the stock price has fallen so far, the dividend yield has spiked. At $47, the yield is sitting at 3.9%.
Nearly 4%. That's getting into utility stock territory.
It is, and here's why that matters structurally. There are massive income funds, pension funds, dividend ETFs that have algorithmic rules. When a blue-chip quality stock like NVO hits a yield of 4%, these funds have to buy it.
So it acts like a floor under the stock price.
Exactly. It creates a natural buyer at these levels. If the stock drops to $45, the yield goes over 4%, and even more money floods in to capture that income. It prevents the stock from just free-falling.
The report also mentions the PEG ratio is beat 7. We hear PEG a lot, but quick refresher, what's the magic number there?
PEG is price earnings to growth. The rule of thumb, especially for growth investors, is that anything under 1.0 is considered undervalued.
And we're at 0.7.
Yeah, 0.7 is dirt cheap.
Yeah.
It means you're paying less for the stock than its growth rate justifies. It implies the market is just significantly underestimating its future growth.
And looking at the history provided, every time NVO has dipped below a 20x PE, it's been a massive buying opportunity.
It's a recurring pattern, and we're currently at 13x. That is lower than its valuation during the pandemic lows of 2020.
Wow.
Think about the psychology of that. The market is valuing this company less generously now when they have the best-selling drug in history than it did when the global economy was shut down and nobody could leave their house.
When you put it that way, the disconnect is just glaring. Okay, let's get to the part everyone wants to know, the forecast. The report has a specific price target, $75.
That is the number.
Walk us through the math. How do we get from 47 to 75? And please keep it simple. I don't have my abacus with me today.
Yeah. It's actually surprisingly conservative math. We're not relying on hope here.
Yeah.
Step 1. Look at the estimated earnings per share, or EPS. The report pegs this at $3.63.
Okay, 3.63 per share. Got it.
Step 2. Apply a fair multiple. Now, we're not going to use Eli Lilly's 45x multiple. We're not even going to use NVO's historical 40x. We're going to be extremely conservative and just use a PE of 20x.
Which is still well below the sector average, we should point out.
Right. So 20 times that $3.62 in earnings gets you to roughly $72.60.
And
then you add a small growth premium, because remember, they're growing revenue at 25% a year, and that pushes the fair value target right to $75.
So this isn't about predicting a miracle, it's just reversion to the mean. It's just assuming the stock stops being priced like a disaster and starts being priced like a normal, healthy business.
Exactly. The thesis is that gravity works both ways. Just as stocks can be overvalued, they can be undervalued. And eventually, price chases value.
So what triggers the chase? What's the catalyst that wakes the market up?
It could be a few things. An upcoming earnings beat would prove the demand is still there. Or positive trial data for their next-gen oral GLP-1s.
Right, the pill version. That would be huge.
If they can prove they can move from injections to pills effectively, that changes the whole game again. But, truthfully, sometimes you don't need a specific news event. Sometimes smart money just looks at the yield, looks at the PE, and just quietly starts buying. That creates its own momentum.
And for those watching the charts, are there specific levels to keep an eye on?
Yes. There's a hard floor of support at $43. That's where the buyers stepped in aggressively last time. The immediate ceiling, the resistance, is right around $52.
And the breakout level.
If we get a daily close above $55, the report argues that confirms the path to $75. That breaks the whole downtrend structure.
55 is the line in the sand.
That's the key.
This has been a really illuminating look, not just at a stock, but really at market psychology. It feels like one of those moments where the crowd ran one way and the math is just standing still, pointing the other way.
Markets are emotional machines in the short term, but they are weighing machines in the long term. Right now, the emotion is fear. But the weight of the profits is starting to tip that scale.
So to wrap this up for our listeners, what's the big takeaway from all this?
The takeaway is that opportunity often looks boring. It doesn't look like a flashy headline on cable news. It looks like a discrepancy on a spreadsheet. It looks like a PE of 13 when it should be 25.
It's about doing the homework when everyone else is panicking.
Precisely. And I want to leave you with one final thought. We've been focused on this $75 target, and that seems like a nice win. But remember that devil's advocate question you asked earlier.
About whether they should be valued like Eli Lilly.
Yes, the $75 target assumes Novo only gets half the respect Lilly gets. But ask yourself this. What if the market realizes that this compounding pharmacy threat was a total nothing burger? What if Wall Street decides Novo Nordisk deserves the same 45x multiple as its competitor?
Then we are not talking about $75 anymore.
No. If Novo re-rates to match Lilly, we're talking about a stock price north of $100. We're talking about a double from here. That 10% move yesterday, that might just be the first tremor of an earthquake.
Wow.
So the question you have to ask is, are you watching the price, which tells you what happened yesterday, or are you watching the value, which tells you what's likely to happen tomorrow?
That is a powerful thought to chew on. Thanks for breaking down the math with us today.
Always a pleasure.
Don't forget to like, share, and subscribe for more.